I worry when I don't worry, right? Because that means we're complacent. And so we still have uncertainties with Delta, with Ida, with peak growth. I think I've been saying consistently, we're at peak growth. We're at peak earnings growth. But we are not going to be, we're going to be above trend. We're going to continue to grow. And I think that is supportive of solid earnings, double-digit earnings, and very solid GDP growth. Maybe it's not going to be 8, 9, 10% like we're seeing right now. Maybe it falls to about 4% or so next year, but that's still very supportive, again, of earnings and of stocks, and that's why stocks are at highs, right? Look, September is always a seasonal, I think it's always seasonally soft, right? August and September. And now we have the end of earnings, and now we know the Fed wants to taper. So we have things to worry about. Let's climb that wall of worry, and I think stocks go higher into the end of the year.
I mean, yeah, Josh, and I was trying to sort of poke a little bit of fun at the media and you know, folks like me and saying this kind of stuff because there are so many things. COVID cases resurgent here and in China. You talked about hurricanes. We talk about Afghanistan. We talk about all those things, and yet the market continues to plow higher, even to Stephanie's point, in what is a seasonally weak, historically speaking, of course, anything can change, part of the year. I mean, what are you hearing? What are you advising your clients to do?
Couple of things. First of all, you are the media, Sully. I watched you yesterday, I think for 3 hours. Is everyone on vacation? Are you the last man standing? You did a great job. I want to correct something about this being a seasonally weak period. We're going into September, and actually September starts the best 6 months of the year. The thing is, though, some of the biggest crashes in history have occurred in late September through October. So it's actually not seasonally weak right now, seasonally strong. However, you do get these historic and memorable bouts of volatility. I don't invest based on that stuff. I have a lot of respect for Jeff and Yale Hirsch and the Stock Traders Almanac, but I don't think that stuff's really actionable. If you tell me that, you know, 58% of the time there's a 20% correction in October, I'll say, okay, are we in the 58% of the time or are we in the 42? Oh, I don't know. We'll find out. I'll tell you in November. So forget about that. Here's the big picture. We have strategist after strategist come on the show. Sully, not your fault. You're not usually hosting. And they tell us that we're overdue for a correction and that there's going to be, you know, a 10% dip or big volatility. It's not a profound statement. On average, every 18 months, you get a 10% sell-off in the stock market. So saying that is like saying, oh, it might be 75 degrees in San Diego today. Yeah, we understand that. What I continue to point out is listen to these year-to-date returns. Facebook plus 38%, Google plus 65%, Microsoft plus 38%, and now, yesterday, Apple finally breaks out to a new all-time high. Apple's only up, I say only in air quotes, 15% year-to-date. As long as those four stocks, which represent 40% of the NASDAQ, 25% of the S&P, throw in NVIDIA, throw in a couple of others, as long as those stocks are holding up, everything that you hear is just feelings. It's just commentary. And that has been the case all year. So what else you want to talk about? You want to talk about divergences in the Russell 1000 value? It doesn't matter. They're not big enough. Okay? So this is where I am.
I agree.
I've been all year. It's been the right call. By the way, and I hope more people recognize that.
Don't jump the show because we're going to talk about the narrowness of the technology market, the ETFs, but that's in like 10 minutes or something like that. But these are good points. And I agree with pretty much all of them, by the way. Spending part of my childhood in Encinitas, California. Go Chargers, who play at SoFi Field. Let's bring in Liz Young. All right, Liz, I hear what Josh is saying. Certainly, it makes a great point about statistical averages, right? You can be up 9 years, fall 20% 1 year, and suddenly you're down on average. It's called math. But there are risks out there that the market does appear to be ignoring for whatever reason. What is the whatever reason?
Yeah, well, I don't want to be one of the strategists that comes on and does what Josh just said and call for a 10% correction here. So I won't do that. But what I will tell you is that I do think September is going to be at best a pause in the rally. And a lot of it is because there's no new good news coming. Steph already mentioned it. we're kind of at this pause in earnings season. There's not a lot of news that's going to come out on earnings. I think earnings are great. Earnings are strong. Corporate America is doing really, really well. We're not going to hear a lot about it in September. What we do have, though, is the Fed dot plot on the docket. I feel like I'm the only one who's talking about that. It happened in June the last time. The market didn't like it because it moved rate hike expectations forward. I think there's a chance that that happens again in September. We also have this debate in Washington, and the market doesn't usually like that either. We've got the budget, and we're forgetting, I think, too, to talk about the fact that we have tax hikes that would be included in that budget. I think that's part of why you saw the sentiment data get hit in August, because people are expecting tax hikes to come at the end of the year. So there are definitely risks out there. There are always risks out there, though. So what do you do in September about that? You use it as an opportunity to position yourself. If you have a bunch of cash on the sidelines, I don't know that there's a lot of people left with cash on the sidelines at this point, but if you have cash on the sidelines, it's an opportunity to position yourself, and we can talk about some of those trades later. But the last thing I would say about this is, I think the bigger worry is about feelings, and Josh mentioned this too, but it is about feelings, and it's about the idea that we haven't seen a correction in so long, so we forgot what that looks like. And there are a lot of new investors in this market that have never seen a correction like that. So when it happens, it's going to test their conviction, it's going to test all of our conviction, and we have to be able to hold on through it.